Good morning, social media. How you guys doing today? I hope you guys are having a good day. I just want to come on real quick just to give you guys a quick little understanding because I was watching someone's live, and I'm telling you, sometimes people need to stay in their lane when it comes down to this finance stuff because you could mislead a population or a demographic of people if you don't understand. And I always tell people that not because you have a voice or you think you may have a little knowledge that gives you the power to give people advice about certain things. And I always said until you're fully informed and fully educated and have a greater understanding, then you should be able to talk about a certain subject. And this finance things, you know me, I'm Mr. Finance. So I definitely put in well over a lot of study, a lot of research into finance, and a lot of things that comes out of it that makes it very understanding. And one of the things that I couldn't wrap my hand around when I was listening to this person, he was informing the people that listens and follow to him, and he was saying that people should not invest their money into retirement and they shouldn't get that false stigma of thinking about later. And I'm sitting there, he was saying the bank and 401ks and life insurance and all these things are not a great idea to use or even to think about long term and not to save for the future. And I'm just sitting there like, it's either I'm just stupid or he's just really smart. And the thing that I want to come on here and let you guys know that some of what he said may have made sense, but when you're gonna tell me to tell someone not to think about the future and think about their retirement, I think that's the most I'm trying to be nice. I'm trying to find words. If you see me pausing, I'm trying to find nice words. Anyway, I think that's the most inappropriate thing to say. And let me give you guys just a quick understanding so you could get a better understanding. Because most people don't understand finance. And I always tell people, if you understand taxes, you will know where to put your money. Right? Don't listen to me, don't listen to them. But if you understand taxes, you will know where to put your money. Until we stop paying taxes and taxes stop playing a role in how money is distributed or how it flows, then I would stop talking about taxes. But for now, if you understand taxes, you will know where to put your money. And that's one of the things that we try to teach everyone, is mostly about understanding taxes and how my money is going to be taxed when I need it. Because here's the thing. There's no such thing as not paying taxes. You're going to pay tax. You will pay tax. Somehow, some way, you always have to pay tax. If you avoid taxes, Uncle Sam, IRS, they will come and get you. I promise you. These guys are like the mafia. They will find you. Alright? So, you have to pay tax. You're not going to avoid it. Okay? Right now. At least. That's why I'm going to leave that subject at. There's deeper things that we could go into on that, but I'm just going to keep it general. Alright? So, generally, everybody got to pay tax on their money. But there's 3 ways you get taxed on your money when you need it. You're going to get taxed now, which is taxable. Now, the vehicles that are taxable money is in your checking account, savings, CDs, mutual funds, stocks, and money market funds. These accounts are what we call taxable money. You have to pay tax on it at the end of the year. You got to report it to the IRS. All right. Most of the time, if you earn over $10 or more in any investment, including your bank account, which is your savings and check-in, you have to report it. Well, they report it, and you have to claim it at the end of the year on what's called a 1099 report form. All right, so that's taxable money. Now they have something where they're gonna tax you later on when you need your money. That's also known as tax deferred. Tax deferred vehicles are in 401ks, 403bs, 457s, IRAs, annuities, and your pension. These vehicles are called tax later, also known as tax deferred. So what they are pretty much is this. These are pre-tax money. That means they didn't tax you on them yet. But when you start receiving these money, they're going to tax you as ordinary income. All right. These vehicles are also known to be that you can't keep money there forever. You have to start taking the money out by 70 and a half, or you're going to be penalized 50%, which is because you failed to take out the required minimum distribution. Also, the other thing is that if you touch the money before 59 and a half, they're going to give you what's called a 10% penalty in addition to taxes. Okay? So these vehicles are also known as retirement vehicles, right? And retirement is broken down into two different categories. It's either a defined benefit or a defined contribution plan. Now, a defined benefit plan is also known as a traditional pension. And a traditional pension is something that you already know how this works. If you don't know, let me explain a little bit. The way a traditional pension works is that it's based upon the amount of years that you work, and it's also based on the salary level that you're at, and then they will tell you how much you will get based off those two things. The good thing about a pension is that if you even live, it will pay you until you die. And even when you die, it would even continue for your spouse or a beneficiary. That's why they call it defined benefit, because you know what you're going to get when you retire. Now, defined contribution works a little bit different. Now, defined contribution is known by its IRS tax codes, because it's an IRS tax code, the 400 tax code, which is the 401k, 403bs, 457s, right? These tax codes let us know that you will be taxed later on. So defined contribution is pretty much goes like this. It is based upon, it doesn't work like the pension, because the way a defined contribution work is, it's unpredictable, because what you put in, right? What you put in, you won't know what you may get when you retire, due to the fact that the market fluctuation, right? So if the market goes up, you make money. If the market goes down, you lose money. If the market goes up, you make money, you lose money. So you're never going to know what you're going to get. But here's the one thing you will definitely know with a defined contribution. You will definitely know how much of your money you put in it, but it's hard to tell you what you may get. So that is tax deferred vehicles, okay? Now, there's something also known as tax advantage, where when you need your money out, you don't get taxed, because tax advantage money is where you already paid tax on that money. So when you have in certain vehicles, what happened is that you don't pay tax on the gains. So if you started out with $100, they're gonna tax you on 100, but when it grows to 1,000, you don't get taxed on 1,000 when you're taking it out. Now, the most important one is about life insurance, because life insurance comes with a lot of tax advantage. Literally, IRS guidelines give tax advantage a lot to life insurance. And a lot of people did not know that the Internal Revenue Service give a lot of favorable tax advantages. And the 4 great tax advantages that life insurance get is that you get tax-free death benefit. So that means that if something happens to you, your family will get your death benefit plus the cash value tax-free. Also, you get tax-deferred earnings, means that you do not pay taxes on the gains. You also get tax-free withdrawals and tax-free loans. As long as you stay within the IRS guidelines, you don't have no liability to tax to pay taxes and so on. And that's one of the greatest kept secret about that. And when you're putting together your retirement plan, right, you need to do something called the 10-20 rule. You need to know what you need. And always use a simple formula to do so, and it's called the 10-20 rule. The 10-20 rule says this: you need to have 10 times your income in place if something happens to you. So that means that if you make $50,000 a year, you need to make sure you have a life insurance that gives you about $500,000, right? Because it takes about 10 years for the survival spouse or the kids and so on to have a transition. So at least you can secure your income for 10 years and doing it that way. Also, you need to make sure that you have 20 times, right? Your goal is to save 20 times your income for retirement, because the average person retired at the age 65, and they said the average life expectancy for someone is about 85 years old, right? So if you make sure that you have, if you want to make sure that you have at least a good $60,000 coming in on a yearly basis, you need to have at least, I believe, either 1.4 million or 2.4, and that could change as well as throughout inflation happening throughout the year. So life insurance is a great way to keep up with inflation. Also, you can use annuity if it's structured properly. So my biggest thing is we got to start educating ourselves and learning more about taxes, and it's not that complicated. A lot of people don't know a lot, and a lot of people need to stay in their lane when it comes to this finance stuff. So like this, share this, tell a friend, let them know. Call me if you ever want to talk about it. My number is 973-873-5977. Once again, my name is Mr. Finance, also known as Keon Corniff. And just remember that you're always one decision away from changing your future for the better. Have a wonderful day. Be smart.